Hello, and welcome to Marty's Money. Today we're diving into a critical topic for anyone looking to understand the bigger financial picture: central banks and how they shape the economy. You might ask, how does understanding the Federal Reserve and the European Central Bank help me reach financial freedom? By the end of this video, you'll have a solid grasp of how central banks affect everything from inflation to interest rates, and how you can use this knowledge to make smarter financial choices. What is a central bank? Central banks are special institutions that oversee and manage a country's money supply and credit. They don't operate like commercial banks where individuals deposit money. Instead, central banks work to keep the economy stable by controlling inflation, regulating money supply, and setting interest rates. The Fed in the United States and the ECB in Europe are two of the most influential central banks globally. Functions of central banks: control inflation. Through adjusting interest rates and other tools, central banks maintain a target inflation rate. Lender of last resort. In a crisis, central banks lend money to commercial banks to prevent financial collapse. Issuing currency. Central banks control currency issuance, impacting exchange rates and trade. The Federal Reserve: history and structure. The Federal Reserve, known as the Fed, was created in 1913 in response to financial instability and bank failures. The Fed's goal is to ensure the stability of the American financial system. Structure of the Fed Board of Governors, a 7-member board that sets broad policies. 12 regional reserve banks. These banks implement policies and report on economic conditions across different regions. Federal Open Market Committee, or FOMC, comprising members from the Board of Governors and Reserve Banks. The FOMC makes key decisions like setting interest rates. Key functions of the Fed: monetary policy, adjusting the money supply and interest rates to support economic growth and stabilize prices. Financial supervision, monitoring commercial banks to prevent excessive risk-taking. The European Central Bank, or ECB, was established in 1998 as the central bank for the Eurozone, a monetary union of 19 European countries using the euro. The ECB's mission centers on maintaining price stability across the euro area. Now let's talk about the structure of the ECB. The Governing Council sets interest rates and monetary policy for the Eurozone. The Executive Board oversees daily operations and implements policies. And then we have the General Council, which comprises representatives from all EU countries, supporting coordination and exchange rate policies. The goals of the ECB are pretty straightforward. The ECB's main objective is controlling inflation, aiming to keep it below but close to 2%. Unlike the Federal Reserve, which balances multiple objectives, the ECB's sole focus is on price stability across the Eurozone. Central banks use a range of tools to manage the economy, affecting everything from the prices you pay to the interest you earn. Let's break down some key tools. First, interest rates. By raising or lowering interest rates, central banks influence borrowing and spending. Lower rates encourage borrowing and investment, while higher rates control inflation. Next, we have open market operations. This involves buying or selling government securities to control the money supply. And then there's quantitative easing, or QE. During crises, central banks may buy assets on a large scale to inject money directly into the economy, lowering long-term interest rates and encouraging spending. The Fed, ECB, and global financial stability. The Fed and ECB don't just impact their regions, they play essential roles in global stability. For instance, during the 2008 financial crisis, both central banks cut interest rates, provided emergency loans, and coordinated to stabilize markets. Global influence examples: financial crisis in 2008. The Fed's QE policies provided liquidity, while the ECB followed with similar interventions. During the COVID-19 pandemic, central banks again cut rates and purchased assets to prevent economic collapse, demonstrating their role as stabilizers in times of crisis. Impact on personal finance, why this matters to you. Central bank policies directly impact interest rates on everything from mortgages to savings accounts. When the Fed or ECB changes interest rates, it can mean paying more or less for loans and credit. Likewise, low interest rate periods can encourage investing, while higher rates may mean prioritizing debt repayment. Practical effects: mortgage and loan rates. Lower rates reduce borrowing costs, while high rates mean more expensive loans. Inflation and purchasing power. When inflation rises, your money buys less. Central banks work to control inflation, impacting long-term savings. Investment markets. Central banks influence stock and bond prices. When they buy assets or lower rates, asset prices often rise, creating opportunities for growth. Applying this knowledge to financial freedom. With an understanding of central banks, you can align your personal finance strategies to economic cycles. For example, during low interest rate periods, you might consider investing more aggressively. When rates rise, focusing on debt reduction and emergency funds could be more advantageous. Personal finance strategies. Low interest environment favor long-term investments, as cheap credit often boosts asset prices. High inflation periods. Consider investments that historically perform well under inflation, like real estate or inflation-protected bonds. Emergency fund preparation. Keep a cushion, as high interest rate environments can make borrowing costly. Conclusion. Understanding the Fed, ECB, and central banking policies can empower you to make better financial decisions. By following these economic signals, you can plan your finances more strategically and stay prepared for market fluctuations. If you enjoyed this breakdown, be sure to like, subscribe, and check out more videos on Marty's Money for insights on building financial knowledge for personal success.